welcome to Looking at the Markets with David Modell. I wanted to explain in depth and detail the 3 trading day waiting rule, which I talk about a lot in my videos. And before I get started, if you want more help, if you want some assistance with putting together a trading or investing plan, you can email me for coaching at davidmodell@gmail.com. A lot of times I will look at charts like this. This is Disney stock, the daily candlestick chart from finviz.com. Each candle represents 1 day of price action, and so this is good for swing trading, where you buy and hold for a few days maybe, or a few weeks, something like that, a couple months. So oftentimes I like to buy low with the idea of hopefully selling higher. And I'll see a stock go down a lot in one day. Like Disney stock had a big gap down. And so hopefully you can see this candle, okay? So this was a bad day, okay? A big down day for Disney stock, all right? But I didn't buy here because of the 3 trading day waiting rule, because I figured after a big down day, there's a decent chance that it might keep going down over the next several days, and that's exactly what happened, okay? So what counts as a big down day? Well, you could have a big gap down, or you could have a long red candle, or a combination of the two. Like this candle over here has a gap down and a medium-sized red candle, and so the whole thing is pretty big with the down day. Here's another example of that exact same thing. Okay, a gap down and a red candle adds up to a big down day. Now this last candle here, I know it looks like a big green one, but really it was a down day. But just barely. It was almost flat, down 0.33%, which is not very much. So this is actually a pretty decent day compared to the last 4 trading days. All right, so you can see that after waiting, the bleeding has subsided, so to speak. All right, and this might actually be a good time to start counting for the 3 trading day waiting rule, and I will explain that now. So let's go to the top here, the 3 trading day waiting rule. After a stock goes down a lot in one day, sometimes the stock will continue to go down during the next several trading days, like we saw after that big gap down with Disney stock. The 3 trading day waiting rule is designed to prevent swing traders from buying a stock or a commodity, currency, cryptocurrency, etc. at the wrong time. This rule is not perfect, and it does not work 100% of the time. I will be talking about stocks here, but this rule can apply to other things like gold, Forex, Bitcoin, etc. So let's talk about, why do stocks sometimes keep falling after a big down day? Why does this happen? Well, there are a number of reasons, but here are the 2 big ones that I've noticed. First, not everybody watches the news every day, and not everybody watches their portfolio every day. Some investors won't notice that their stock is down until a couple of days later, and then they panic sell. So that's one reason that a stock might keep falling after a big down day. Another reason is this. For several days after a stock goes down a lot in one day, analysts and article writers will publish negative opinions about the stock. Investors will read the opinions of these so-called experts, and they'll sell their stock shares. So that's a couple of reasons why it might happen. So what does it look like on a chart? Well, we just looked at Disney, but I'd like to explain it a little further. On a candlestick chart with daily or one-day candles, you'll see a big gap down or a long red candle, or sometimes both. And again, that's what I'm talking about here. Big gap down, long red candle, or sometimes a combination of gap down and red candle, okay? And I call those big down days. After the big down day, you might see a medium-sized down day and then a small down day. In other words, the gap downs and red candles might get smaller and smaller. Okay, that's as the panic starts to wear off in the markets. The idea is to wait until the panic and the downward momentum have subsided and the market is ready to bring the stock back up again. You probably don't want to catch a falling knife while it's still falling fast. So here's a big question. When do you start counting the 3 days? Remember, the rule only counts trading days when the stock market is open. Don't include weekends and holidays when you're counting the 3 days. Now, this does not apply to assets that trade 7 days a week, like oil or gold, silver, currencies, Bitcoin, things like that. Okay, this is just for stocks. When you see that first big down day, that's day 0. It's not day 1, it's day 0. All right. So with Disney, that first gap down, that would be day 0. All right. If the next day shows some improvement, meaning it's either green or flat or maybe slightly red, but not too much, that's day 1. If the next day after that shows some more improvement, that's day 2. By the third day, the daily candle should at least be flat. A green candle would be even better. You don't have to buy the stock here, but you can look at it more favorably and maybe consider it. At least you're not catching a falling knife now. Okay, so I'm not telling you necessarily to buy after 3 good days. I'm just saying you don't even consider it until at least 3 good days have happened. Now, if at any point during the 3 days, you see a big down day, the counting of days starts over. The big down day is day number 0, and you're starting the counting all over again. All right. So Disney is a perfect example. Okay, you have a big down day. This is day 0. Another big down day. So again, we're still at day 0. Another big down day. Still day 0. Another big down day. Still at day 0. Okay. Here's a fairly decent day. So I can actually count this. If this right here, this is day 0. And this one closed right about here, right about where it opened. So a pretty good day, I would say. Not bad. All right. Again, sometimes I wouldn't count this if I wasn't comfortable with it, but compared to the last few days, this was a pretty darn good day. All right. It was pretty much flat, close to it. So I would count this last bad day here, this last red day here, as day 0, and now this is day 1. I would count it as day 1 because it's a pretty good day. It's at least acceptable. All right. Day 0, the last bad day here, and then day 1 would be this flat day here, that last candle. Okay. And I'll show you some more examples. All right. So what if, and just to go back really quickly, okay, so this is day 1. Now, if the next trading day, it's a big, awful day again, big, bad day, then it would be right back at day 0 again, because I don't want to catch something while it's still falling fast. Okay. But if we had a couple more, good days, at least flat, or better yet, starting to curl upwards, then I might buy some shares, or at least consider it. Okay. So if this is day 1 and the next day is good, day 2 is good, let's say it goes up here, and the next day, day 3 starts to go up here, then I might buy. I might buy at the close of that day or the open of the next day. Okay. Because oftentimes I will wait until the end of the day to see how the candle finishes. Okay. Because it might start high but then fall all day long. Okay. You don't know if it's a good day or a bad day really until the end of the day. All right. So I hope that clarifies a lot of it. Now, what if after a big down day, which is counted as day 0, right? What if then the stock shoots up really fast during the next 3 days? So let's say if Disney, okay, so here's, if this is day 0 and then this flat day is day 1, what if in the next couple days it just goes up, just huge green candles? All right, so now, goes all the way up to 140 or 150, let's say. All right, those would be really big green candles. But yeah, it could happen. Let's say it went, up a whole lot to the point where it's almost at resistance here, the resistance level at 152, 153, something like that. So yeah, let's say you start counting day 0 during a big down day. Then during the next 3 trading days, there are giant green daily candlesticks. So after 3 days, the stock is now expensive. I probably would not buy the stock at that point because I usually don't buy stocks when they're expensive. However, momentum traders might choose to buy the stock at that point. So it's really up to you, depends on what kind of trader you are. If over the next 3 trading days, let's say pretend Disney just bounced up to 150, where it's near the resistance level here, I wouldn't buy it because I would feel that now it's short-term expensive. But some people might. A momentum type of trader might buy at that point because they would feel that it's got strong momentum upwards. That's cool if that's your style. My style is more buy low to try to sell higher. So it depends on your style of trading. I would prefer to see the stock go sideways, or better yet, curl up moderately. So I really like when it makes like a fishhook pattern after starting to, after the market calms down, like it's starting to do here. It looks like I'd like to see kind of a fishhook kind of thing, or at least sideways. But if it curls upward, that's even better. Yeah, so I'd prefer to see the stock go sideways, or better yet, curl up moderately. That way I might be able to buy it while the price is still low, but not while the stock is falling fast and while traders are still panic selling. So that's the idea. And here's another example with Twitter. Okay, this is a daily candlestick chart from Twitter, and you can see a huge gap down. And notice that, remember how I talked about how after a big down day, oftentimes you'll see a medium down day and then smaller, right? And so that's what's going on here, all right? But if you bought in at the right time, you would have done quite well, as you can see. It ended up, way up here, all right? So let's take a close-up look at that same chart, all right? This is still the same Twitter chart, just a close-up. Okay, so you have the big gap down. So this candle is day 0. What about the next day? Well, it's still falling. I'm not super comfortable with that. It's a judgment call, but I don't like that. I don't like this candle. So I'm going to stay out of it. So this is, again, day 0. I'm not even starting to count yet. Next day, the candles are getting smaller, still not flat enough for me. I might accept a really small red candle, but I would still, no, not yet. Still day 0. This one I'd be pretty comfortable with. I mean, that's almost flat. So I'd count this as day 0. All right, and I would count this as day 1. I know it's red, but if you look closely, hopefully you can see it. It closed right about where it opened. It looks like it went up a little bit, but then went down and closed right near the open. So if this is day 0, I'm still pretty comfortable with this. I think this is sideways. So this is day 0. This is day 1. This is day 2. Again, closing around, pretty flat. And this is day 3. So you got 3 days of flat. So now it's a judgment call. Some people insist on having it curl up, but if I really like Twitter, I would probably, again, you're looking at other factors. I would look at the news, things like that. Is Twitter in solid shape financially, that kind of thing? So let's say I decided, yes, buy here. Okay. Great. Well, I would have bought here and it would have went down a little bit, then it went up a little bit, chopped around, that kind of thing. Okay. And as you can see, so that would have been, right about here. And then it chopped around, but it did go up quite nicely. I'm not saying it always happens like this. This does not happen 100% of the time. All right. But at least, that would have been better than catching a falling knife, like buying here and then have it just keep going down for the next few days. All right. So the idea is to avoid that. All right. Let me show you another example. JP Morgan Chase, JPM stock, daily candlestick chart, big down day. That's day 0, but then a gap down. So still day 0. See, so I wouldn't have bought for a little while. Okay. Now, if you bought at the right time, you would have done quite nicely because it went up. Let's take a closer look at that same chart. This is a close-up of the JP Morgan daily candlestick chart. So big down day. Okay, day 0. Another, sizable gap down. Still day 0. Not even starting to count yet. Another, I don't like this red candle. It's too big. So not, still day 0. Still day 0. I don't like this one. Still day 0. Not comfortable yet. Not comfortable yet. Let's say you started a count here, though. Let's say you were okay with this candle. Fine. So this would be day 0, but then a gap down. So I would still start over then. Still day 0. Still day 0. Still day 0. I don't like this price action. This is a small red candle, but with a gap down. Still not comfortable with it. Definitely not comfortable with this one or this gap down. So this is day 0 still. But then, this looks like the market might be ready to quit selling so much, okay? So this is day 0. This is day 1. Things are looking encouraging. Day 2, still looking encouraging. Day 3, here we go. I know it's a red candle, but almost flat. So, because it looks like it went up, but then closed almost flat from the previous day. So I might buy here. I would do my research. I would look at it, maybe look at other indicators, look at the news, that kind of thing. But I might buy here. Okay. The point being, I wouldn't have bought it probably during any of this, or maybe I would have started to look at it here, but then the next few days, no. All right. So, and then, would have bought probably around here, and enjoyed a really, really nice run up after that. Okay. Again, it does not always work out that way. So I hope this was helpful to you. I hope I clarified the 3 trading day waiting rule. All right. If you like this video, please give it a thumbs up on YouTube and subscribe to my YouTube channel and hit that notification bell if you didn't do that already. And if you want some coaching, if you want some more help, I offer the coaching. You can email me for that at davidmodell@gmail.com. I hope this is helpful to you. Thank you so much. I'll talk to you again soon.